video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, am I recording? You wouldn't believe how often I say I do a whole presentation and then come back and find out I haven't been recording any of it and have to redo it and start from scratch. Anyway, alright, hello and welcome to Camel Finance. I'm your boy Camel. We are indeed recording. Now, today I've got a couple of things to point out that are pretty wild, okay? I know a lot of people aren't going to care because it's gold, but the paper market is showing the very early sign of cracks in the system for the paper gold market. I am not one of these people that is saying this thing's about to implode immediately. I do believe it's part of a longer term plan for them to blow up the paper gold market. I believe that's how part of the wealth transfer is going to occur. I do not believe that we're going to see this imminently, okay? I think this is, a few years into the future, but we can certainly see the potential, right? We can see the signaling from the central banks of what is to come in the future. So I'm going to show you that. It's incredibly interesting to me. It feels like we're living right through a movie. Admittedly, a movie not many people would be interested in watching, but if you're a weird trader kind of guy like me, then this is super, super, super exciting times. The next thing I want to talk about is reverse repo, because people keep asking me about that. And I'm going to point at Bitcoin, because again, Bitcoin is showing some very, very interesting signs as we nudge ever closer to that weekly cycle low. So happy days. It's Friday already. The week's gone really fast for me. As always, we'll be back tomorrow to do a macro deep dive. And if you're a level 3 member, I'll be doing a deep dive for you guys in preparation for getting underneath some more trades in the coming weeks. Other than that, sit back, enjoy the show, because these are indeed wild times that we live in. We've just seen another 500,000 ounces delivered today. The entire world's accessible physical gold is being parked 100 feet below Manhattan. And meanwhile, London is now empty. And if you don't understand, hang tight because I'm going to explain it. Before we move on, actually, I want to point out that on this channel many, many times before, I have pulled up the KIDS documents for the ETFs, and I have shown you that in those KIDS documents, it says that by owning this paper gold, should the provider of the ETF or ETN or ETP, whatever, ETC, should they not be able to pay you out, you accept full liability, okay? So whether or not we're aware of this, whenever we trade paper gold or ETFs, we are accepting full responsibility in the event that their chicanery should cause them to not be able to pay you. As ETF holders, we are the fool guys that accept full liability and responsibility. And remember, depending on which ETF provider it is, there are 10-to-1 claims on every ounce of gold. Some of these might be as high as 100 or 150 paper claims per ounce of gold in the vaults. So the rehypothecation is real. The borrowing fee for GLD, one of the biggest ETFs, has skyrocketed to over 6%. Now, of course, one of the ways that institutions and central banks keep a lid on price is they short gold and the precious metals via the paper markets. But when we have a very, very high borrowing fee like this, it's much more difficult for them to suppress the price artificially via short selling. Of course, a short sell is a 3-stage process. We must first borrow, then we must sell it into the open market, wait for the price to fall, and then buy it back, and we pocket the difference. And of course, we have to pay a borrowing fee for doing so. But when the fee is this high, it speaks to nature sitting here and saying, don't you dare think about shorting this market. Now, on top of this, silver is even worse. Silver is lagging significantly behind gold, and I have long been suggesting that we are going to see a massive catch-up trade there. But the borrowing fee for silver is now 12%. This is absolutely unprecedented. And this is indeed nature's way of saying, don't even think about shorting silver. So we've got this wild combination of a massively rehypothecated paper, gold, and silver market. Not enough physical gold in the vaults to cover the ETF claims and the paper claims, and the borrowing fees starting to spike to make shorting the price impossible. So what does all this mean? Well, here is a very, very, very nice summary. The gold clearing banks of London have exhausted the metal they have available for delivery in their own vaults. So they are now trying to borrow as much gold as possible via the gold lending markets at the Bank of England, but this looks exhausted too. So that explains this. London is nearly empty. But these clearing banks, which are, for example, JP Morgan, HSBC, UBS, they need to keep gold in their vaults for their own liquidity. It looks like they don't have any more gold to do this, okay? And this is, of course, a product of major rehypothecation. When you only have 1 ounce of gold in your vaults, but you are happy to sell 10, 20, even 100 or 150 people an ETF paper claim on that 1 ounce of gold, that's when we set ourselves up for a total and utter catastrophic collapse of the paper gold market. Now, as ever, it's just the same as fiat currency in a banking system, right? The fiat currency isn't in the bank. Remember Camel's 3 rules of banking. It's not your money, the money's not there, and it's not real money. If we all decide on the same day to go to the bank and try to withdraw our money, it doesn't exist, right? They don't have it because, again, they rehypothecate 10 to 1 on every pound or dollar that is deposited in the banking system. So this is no different to that. It's just everything goes smoothly up until the point when everyone says, you know what, give me my money, right? Can I withdraw my money? And then everyone finds out, oh, actually, they don't have it. And this is exactly what we're seeing here with the gold market. Everything's fine until all of a sudden people need to start to claim their gold back. And then you realize they don't have it. London has been totally emptied. They can't even borrow in between each other now because the fees are so high. And therefore counterparty risk has risen between the LBMA bullion banks, which trade unallocated gold credit between each other. The clearers, the market makers, and all the other bullion banks and brokers and traders are about 50 plus entities. And what they do is they trade paper claims on gold, or the electronic equivalent, but because these claims are now trading at a discount to reflect the fact that they can't be converted at will into physical bullion due to a lack of availability of physical gold. So how does this resolve, right? How does this resolve? This is absolutely insane. This has to resolve in huge upside outperformance here for the precious metal spot prices. Why? Because if you've got physical gold, are you going to give it up right now? Absolutely not. If you've got paper gold or an ETF or something like that, there's a very good chance if this thing doesn't resolve itself that you're going to have your investment go to zero because you're holding a paper claim on a single ounce of gold when 100 other people are also holding the same thing. Again, the gold isn't there. Just like the fiat currency isn't in your bank, the gold isn't there at the moment. What an absolutely wild time to be alive. I should be clear, I'm not calling for this thing to go bang right now or this year even. I think this will all unwind much later on in the decade. I believe this is part of the process of revaluing gold to an obscenely high number relative to today, and again, using that gold price to plug some of the holes in the debt. But unfortunately, part of this wealth transfer is to steal the wealth off of the paper holders, the pensions, all of that kind of thing, and hand it over to those that hold the physical metal. This is a full sit back, eat the popcorn, enjoy the show type of moment. And the too long didn't read is once again, I am here to tell you gold and silver et al. Are going much, much, much higher. Elsewhere, things continue to get even more wild because the reverse repo is now down another 7 billion to just below 80 billion, which is the lowest in 4 years. The liquidity stash is almost completely empty. Here's a picture of it for you. You can see it kind of trades sideways for a while, it pops up, and now we're almost completely drained and empty. So we've got a ChatGPT generated summary of what the RRP is. So I thought I'd just read this. It just saves me explaining it. The reverse repo is a tool used by the Fed to manage short-term liquidity in financial markets. It allows financial institutions like money market funds and banks to park excess cash with the Fed overnight in exchange for Treasury securities, helping to control the rates and absorb the excess liquidity. Now, why does this matter? Because liquidity drying up is one symptom of a sharp decline in reverse repo balance, which suggests that financial institutions have fewer excess reserves and need liquidity elsewhere. It could also cause potential market instability when the RRP drops. It can indicate the financial system is shifting away from parking money with the Fed and instead using it in markets, potentially fueling inflation or asset bubbles. The decline may also signal the Fed is reducing liquidity tightening measures, possibly in anticipation of interest rate cuts or a shift in monetary policy. If the banks are withdrawing from RRP in large amounts, it may indicate stress in the financial system as institutions need liquidity for loans or other obligations. And as a result, we could see incoming rate cuts as the Fed may need to cut interest rates to manage liquidity effectively. We could see a market rally if liquidity is moved into risk assets, forcing things like stocks and crypto higher. We could also see credit tightening if liquidity is running out elsewhere. Credit conditions may tighten, affecting lending and economic growth. And in theory, if too much liquidity re-enters the economy, inflation could reignite. Although remember, my video that I posted called something along the lines of, "The printer is coming, PSYOP." The printer is not actually coming. I know a lot of people like to look at this and say, well, you know what happens? The moment this is drained, we're going to end QT, immediately go to a QE bomb, record printing. No, there's no reason to think that. For some reason, people think that's how it works. It isn't. As I've been making the case over and over and over again, when this is drained, probably nothing happens. Best case scenario, we end QT. And probably nothing happens for a while. Probably no changes. The idea that this is going to be inflationary, even if they did return to outright QE, balance sheet expansion, massive amounts of printing. Remember, inflation requires velocity, otherwise it's just debasement. And even if we have it with velocity, it takes 12 to 18 months to manifest in the economy. It doesn't work like they just print 20 trillion tomorrow and then suddenly we're back at 20% inflation, right? It takes 12 to 18 months to work its way through the system. It lags. So the too long didn't read, okay, is the market could go up or down. They might have to cut rates or provide liquidity. They might have to end QT, or they might not. They might just continue being overly restrictive because they want to engineer a deflationary controlled demolition. Who knows? Right? Who knows? I see a lot of people talking about this, a lot of people kind of stroking it to the idea that the printer is coming. To be completely honest with you, I really, really think this is a nothing burger. Until such time as they actively come out and announce they've paused QT, until such time they come out and say, we're going to start aggressively cutting 50 basis points, until such time as they come out and say, we've got a new form of stealth QE that we're going to use to top back up the reverse repo facility, until such time as something actually happens, then who cares, right? That's the approach I'm taking. Now, one thing that is very interesting is, as I often say, cycles are in control. Everything else is a narrative that investors and traders append to explain away price action. This just so happens to be on pace to be completely drained by about early March, right? Late this month, early next month. Now, why is that such an interesting coincidence? What do we happen to know is due right at the end of this month or early next month? Well, of course, the answer is the cycle lows. A major weekly cycle low for Bitcoin. We've got a cycle low for the stock market, and we've got a daily cycle low for gold as well. So it just so happens that right as this thing is due to be drained, we've got the cycles bottoming and telling us to expect and anticipate big upside moves in the markets, at least in the short term thereafter. So maybe, just maybe, we will see some news manifest. Maybe we'll see them top this thing up. Maybe they're going to announce a pause to QT. Maybe we're just going to get a nice 50 basis point cut and the market will, jump up and down over that. Or maybe this overly restrictive policy resolves to a very, very, very fast and rapid drop in inflation, and then investors can get all excited about that and bid risk for a little while longer. Who knows what the narrative will be? But what we do know, objectively speaking, is it doesn't matter what the narrative is because the cycles are due to bottom, and therefore we've got a high probability setup out of those cycles. So super, super, super interesting times. I know a lot of people get super hung up on this. I really don't think it matters, to be honest. And so the last couple of things I want to point at is the US is also thinking about putting together this sovereign wealth fund, which is going to be managed by a guy who personally holds around $1 billion in Bitcoin. And this $1 billion Bitcoiner gets to choose what assets go into the fund. So what would you do if you were him, right? I mean, this is absolutely crazy. It's absolutely crazy. We've also, a lot of people keep asking me to cover Ethereum, and we've got Ethereum apparently about to generate one of the most hated rallies. Now, I thought this was quite interesting because to me, the people that hate Ethereum the most are the people that hold it, right? If you didn't hold Ethereum this cycle, if you sold out or whatever, or you never bought it, or you went all in Bitcoin, then how can you be hating on Ethereum? You made the right decision. It's a very interesting setup to me. It seems like the people that are hating on it are the ones that bought it, assuming it was going to outperform again, and it didn't. I also think something that we can observe objectively with Ethereum is, apart from the kind of like toxic Bitcoin maxis that are like, haha, ETH's trash, right? Apart from those people, this seems to be one of the most crowded trades I've ever seen. Almost everyone I've ever interacted with that holds Ethereum, number one, fully assumed this thing would be outperforming by now, and number two, is still 100% sure of themselves that at some point it's going to have a catch-up rally. Even me, who doesn't like it, doesn't hold any, is happy not to hold any, and is totally indifferent to the outcome, would be kind of surprised if what happens next is we get a weekly cycle low for Bitcoin, a double to 180k, and then some of that money doesn't rotate into Ethereum. I would be somewhat surprised if Ethereum doesn't at least get some kind of pump very late in the cycle. Now, anyone that's been here for a while knows that it was never my expectation Ethereum would do well, at least not until much later in the cycle. But even me, who has no interest in trading it or holding it or any of that, would be kind of surprised if it doesn't get some kind of pump late cycle, right at the very end. But this makes me think that everyone is thinking the same. And you know that saying, right? When everyone's thinking the same, someone's not thinking. Why does it have to rally? Okay, would the pain trade be a big pump here? If Ethereum does a 20x, does that reward the majority of the market participants or the few? Because I really think if Ethereum is to do a 10 or 20x from here, most people will be quite satisfied with that. I think a lot of people wrongly bought Ethereum assuming it would outperform, chose not to play Bitcoin, and they're hating it because it's done worse than Bitcoin has, right? They kept thinking by now it would be at least new all-time highs, and it's terrible. It's doing very, very bad. So I think, on a balance of probabilities, the pain trade is actually down here. Now, again, even I am thinking that wouldn't make sense. It would be really strange if Ethereum just didn't take part in the bull run at all. But again, we've got to ask ourselves the question, right? Just because we paint a green fractal here, who do you really think benefits from this? Because people like me, for example, who just said, I don't care, I don't want to own it, I'm going to own Bitcoin instead. If it does a 20x from here, do I care? No, it doesn't affect me. I already caught Bitcoin, right? And I didn't have to go through all the pain and suffering from the bear market lows till now holding Ethereum. So even if it pumps, who cares, right? And if it did start to pump and print higher highs and higher lows, I have the opportunity to choose to hop into it if I want to. But I still think the pain trade is that this thing doesn't actually perform. It just continues to do nothing. I think the pain trade here is it trades like XRP did in the last cycle, where it just kind of does nothing and everyone laughs at it and goes, ha, you didn't make it all-time high. So I don't know about the most hated rally coming. I don't think many people actually care about this. I think the people that hate it are the people that just falsely assumed this thing was going to run higher. So it's a very weird situation. And to me, everyone and his dog seems to think that this is the most likely outcome. But again, if this is true and everyone thinks this is what's coming, then is it likely to occur? I don't think so. And the people that don't think it's coming, they're just simply not going to buy it, which means there's even less buying pressure to drive this thing up. So I don't know, man. I don't know. If you are an ETH holder, I am rooting for you, honestly. I hope that you get to have something out of this market, but I don't think it's going to occur until at least Bitcoin has seen its double. And then I think as Bitcoin is consolidating, you've got a chance to see some rotation. As ever, I'm open to being proven wrong about that. I also found this, and I just wanted to bring it up because I don't really see anyone ever talking about risk management. But remember, mathematically, losses work against you. Okay, a 10% loss requires only an 11% gain on the following trade to get back to break even. By the time you're at a 50% loss though, you need your next trade to double just to get you back to break even. And if you are holding a coin down 70, 80 or 90%, you're in a lot of trouble and you're probably never going to recover the loss. So that old adage in trading of let the winners run and cut your losses early, this is exactly why, because you can't beat maths. Maths work completely against you once we start to exhibit larger and larger losses. So keep those losses small, remember to manage risk. Other than that, things are, to be honest, not really doing anything, are they? There are essentially no changes this week whatsoever. We still have a daily cycle low that is yet to fail for the dollar. Oh, I found a change. Okay, happy days. We've got one change. Okay, excuse me, one change. The 10-year yield has exhibited a breakdown. Happy days. I was expecting a little bit of a counter trend bounce here first and then a breakdown. But wholly speaking, this is good. This is very, very good, particularly if we can get something like this. Then tell that to the bond market is back once more. It's been a long time coming. I wonder if this is also going to be the start of the bond market forcing the Fed to cut rates at the following meetings. If this can continue, that will help us get big risk-on moments out of those weekly cycle lows at the end of the month. Gold continues to upset everyone that ever doubted it, which is really nice. Again, daily cycle low due sometime early March. Let's put this here, somewhere around here. And of course, we continue to capture this in the members section. I know silver, we're expecting to start to outperform. We've got a bunch of mining positions too. So happy days there. No real changes, okay? Long and strong. Oil, again, continuing to follow down into that 4-year cycle low. Happy days there. Congratulations to some of you that shorted this thing. I know some of the members used this setup to short this, although I didn't. Well done to you guys. The stock market, again, continues to do nothing, right? Continues to be range bound, continues to probably need to find some kind of cycle low. And then we got a chance, right? Then we got a chance thereafter. And of course, Bitcoin continues to do a whole heap of nothing. I've drawn a second trend line here, which I think we'll be able to use to confirm the daily and weekly cycle. The thing is still very much sideways, very much looking for something like this. And out of that weekly cycle low, it is time. And we are getting ever closer to that now. In fact, let's have a little measure. Something akin to 3 weeks would be a perfect 60-day cycle low. And remember, we could even see it slightly earlier than that. As you can see, no changes to the markets really. But again, that's kind of been expected since we've been talking about going sideways into the end of the month. It'll be interesting to see what happens to the gold market. It's going to be super interesting to see what narrative we append to this weekly cycle low to explain away the upside price action. And of course, we're going to need these lows to hold. Otherwise, we're going to have failed cycles and start to confirm true downside breaks. And then we're going to be forced to have to call tops. Anyone at that point, after we see failed cycles, that is still remaining bullish is on the wrong side of the trade. So super, super interesting times. For now, we remain cautiously optimistic. We continue to take things one day at a time. And I continue to wish you all the best in life. Have a fantastic weekend. I'm your boy Camel. Until next time, take care. All the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. a badass, oh yes indeed. Camel Finance got the market's key, taking us normies on a bumpy ride.